Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jon Ferro, Lisa Abramowicz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
We're live on TV and radio, counting down to another Fed rate decision and Fed Chair Kevin Warsh news conference. That decision is 30 minutes away. That news conference about an hour from now. This one feels a little bit different. Typically, you know with conviction what the outcome of any meeting will be. They guide you towards it. They hold your hand. This is a different moment. There is just a little bit of two-way risk.
And just to cite Goldman Sachs, they said the idea that there's a 30% chance of a rate hike is so unusual to have that kind of uncertainty heading in that it would be the largest surprise, regardless of what they do, since 1997.
My operative word is mysterious. I think there's all sorts of mysteries. Explain the press conference to me. Are they going to get to McKee? Or is he just going to say, okay, I took 7 questions. See ya.
So first point, TK, I'll say this. We're getting a news conference, and that was news about a week ago, so that's good. How long that news conference will be, I really don't know. But I think there's a third act here, and you and I were talking about it earlier on this week. Typically, at the ECB, you would get a statement, a news conference, then a few hours later, sources. What am I talking about? Sources will speak to a media publication and tell you what really went down in that meeting. And I think the next 2 weeks is going to be key, because in the next 2 weeks, you'll hear from the other officials on the committee about what they really think. So if Kevin Warsh doesn't explain where we are, doesn't articulate a reaction function, if you don't get that from the Fed chair, you'll get it from others.
Especially if there are dissents, as many people do expect. So you expect to hear from Lori Logan and Beth Hammack, who have been incredibly hawkish going into this. Is it just 2, or potentially are there more? Also curious to see whether the bias has shifted to people who believe that there's going to be a rate hike to a greater degree than at the prior dot plot.
Scope and scale, John, before we get to these great conversations, I'm going back to October of 1979. To me, it's the most mysterious meeting since the historic first Volcker inflation meeting. We don't have a clue what's going to happen.
The good news at 2 p.m. is it's easy. The statement is really short, and you go to the bottom. You look for the dissent, right? You look for the dissent if you don't get a decision that says anything but unchanged. This from Governor Waller. Sternly staring at inflation until it melts before our withering gaze is not an option. Put that together with the last line of the last statement. The committee will deliver price stability. Is it enough just to say it, or do you have to do something about it?
Or do some people have to say that they would have done something about it? And Kevin Warsh continued to talk about task forces, and is that enough? I'm curious to know whether this is also going to be 130 words long, or if we're going to get a longer or shorter potential version versus the more than 300-word session statement that we got earlier this year. Look, it is unclear to know exactly how this is going to play out. There clearly is a family flight taking place, and clearly a lot of people are looking for a sense of what their framework is.
Let's get to the market, Bramo. Equities this afternoon. Your equity market a bit softer. We're down by 0.6% on the S&P 500. The slide continues on the Nasdaq beyond day 5. The Nasdaq 100 is negative 0.8, and the Russell gets involved as well. We're down by 1.2 on the small caps. In the bond market, 2s, 10s, and 30s. 2s. Just hugging 430. We're anchored around that rate. Yields up this morning by 3 or 4 basis points. That move continues this afternoon, and crude is not helping. Brent and WTI spiking earlier on today. Brent back in the 90s.
Putting all of these things together, especially understanding exactly how the Fed is going to look at this, coming up shortly. JP Morgan's Bob Michael, SocGen's Subhadra Rajappa, and Bank of America's Aditya Bahave. They will be taking us up to that potentially 130-word Fed rate decision and statement at 2 p.m. Eastern. Then immediate reaction from Jim Bianco of Bianco Research, Diane Swank of KPMG, and Crossmark's Victoria Fernandez. And finally, breaking down Chair Warsh's news conference, Apollo's Torsten Slok and Stephanie Roth of Wolfe Research.
Wonderful.
I cannot wait.
Looking forward to that. What a lineup. Joining us around the table, Bob Michael of JP Morgan. Bob, good afternoon. Good to see you.
Happy to be here.
How easy is this one to predict?
I think it's actually pretty easy. I don't know what's changed since the last FOMC meeting. If you look at inflation where they focused us, we got CPI. Year over year, core CPI was actually a little bit better than the expectation. It's at 2.6%. But if you look at core PCE, it went up a tick. It's at 3.4%. That's kind of a wash. You look at the labor market, sure, there was some improvement when you look at average hourly earnings and the unemployment rate, but non-farm payrolls came in at half what the expectation was. So all of it looks like kind of mixed to me. I don't think you do anything.
Do you think you need to hear from Kevin Warsh what his reaction function is, given the fact that a lot of people are saying it's one thing not to have forward guidance, it's another thing to not understand the Fed's response mechanism?
Yeah, we don't know what he's reacting to. I guess we can spend the next few years trying to figure it out ourselves, but it would be nice if he can tell us what he's prioritizing. Is he prioritizing inflation not at 2% for this period of time is unacceptable? Rates have got to start going up and start that process. If he hikes rates today without any sort of guidance in the past and without anything changing, then I'm going to think his reaction function is just loss of patience and frustration. That's bad for central bankers to have that out there.
Tell me about the J.P. Morgan economics view. What's the key distinction Ferroli and companies see into this meeting?
Well, what they're frustrated by is the lack of a reaction function, particularly without the forward guidance, as Lisa said. I think they also look at everything, and they don't see the need to do anything. When we look at the statement, it will probably characterize the economy as solid. They're expecting the second half of this year for real GDP to come in at 1.8%. That looks more stable to me than solid. I don't know that the Fed has anything to do today.
Let's bring up the bond curve and let's look at the very front end of the curve. Twos at the moment, 433. Yields higher by some 4 basis points. We've been talking about this on Bloomberg Surveillance all week. The difference between that at the front end and the policy rate right now, let's call it 50 basis points. Is that a bet on a rate hike or the risk of one in the yield curve? How would you frame things?
Yeah, the market's pricing in about 2 rate hikes now. And you can go all the way out to the 10-year. You've put 100 basis points between the Fed funds rate and the 10-year. To me, you're pricing in close to 2 rate hikes. Whether that starts today, whether it starts in September, or whether it starts in 2027, the market's a discounting mechanism, and that's the expectation for the next rate change.
If the Fed pushes back against that expectation, is that bullish or bearish for long-term bonds?
I think it's going to be bearish. I think then the market's going to start anticipating that maybe the Fed's not as inflation vigilant as it should be. Why push back on the prospect of rate hikes over the next 12 months? Just leave them there and see if inflation actually does come your way. Then you have a chance to go back to the market and help pull that out. Right now, there's no indication that inflation is going to pull back sharply anytime soon.
Can we do the show? Can Mr. Warsh have a press conference given the war in Iran? Just the headlines coming out about Iran. Oil popping $5 here, $5 there. Is this just a wasted exercise because of the uncertainty, the cacophony of news flow?
I don't think the press conference is 100% guaranteed today. Again, I don't know.
What do you mean by that?
I don't. Sure, everyone's been called to a press conference. You can hand out the statement, and the announcement could be, "There is no new news.
John,
there is no press conference."
John,
I think that would be
we'd
awesome.
Have to fill a lot of time.
We'll have to stop him from leaving. Cancel Bob's
We'd
car.
have to start talking soccer.
I walk back to my office.
Are you suggesting that is actually a possibility, or are you just joking?
I'm more joking than not, but I sit there and I wonder, he said, unless there's something new to say, there's no point saying anything.
Lisa said the same thing this morning.
There is nothing new to say. What is he going to say?
Who was at Jackson Hole? Were you at Jackson Hole? Were you there, John, when it was like a 9-minute speech?
Yeah.
And we were all having coffee.
Are you talking about the Payne speech?
Yeah.
From Chairman Powell a few years back? What would you do if this was really short? Would you be comfortable with that? It just came out, read the statement, took a few questions, walked away?
I guess I've just gotten my head around that Fed chairs are allowed to structure the Fed, all the different task forces, everything that comes out of it, however they like. You have to give them the tools to put in place what they think is best.
Do you think this market has internalized a Fed that's no longer going to hold its hand?
Yeah.
You think we're done with that?
Yeah. And look, was it holding our hand? I take exception to that.
Oh, do you
really? They put out a view, yeah. And when there were times to push back, like in 2021, 2022, we pushed back hard. Did they listen to us? A little bit late.
It felt like hand-holding at the worst of times, didn't it?
Well, it was at those times. When it was necessary, they did that. And probably the Kevin Warsh Fed would do the same. And that's the real question. Is this a moment that requires hand-holding? No. So they have the luxury of not necessarily holding the market's hand. However, there is a difference between holding a hand and providing some sense of exactly what the framework is for the Federal Reserve to act. And if they don't have that, then the accusations of political interference start to get louder.
Well said, Bramo.
Thank you.
Bob Michael at JP Morgan is going to stick around for maybe an hour longer or two, depending on if we get this news conference 50 minutes from now. I hope we do. That decision is about 18 minutes away. In just a moment, we'll catch up with Subhadra Rajappa of SocGen and Bank of America's Aditya Bharve. We'll do all of that and more with your equity market lower by 0.7% on the S&P 500 and bond yields higher by 3 basis points. Your 2-year, 4.32.
This is the first time I can really remember going into a meeting with this much uncertainty.
The market is struggling to figure out what the correct policy course going forward is.
The market's not ruling out July, and honestly, neither are we.
There's not an urgency for the Fed to hike.
I don't think there's going to be any Fed action.
This meeting puts them on a hold.
The meeting this week is likely a no action.
I don't see the rationale for a rate hike. The bar for hikes is relatively low.
I don't think that the Fed is going to hike rates, this year.
I think the inflation data the next couple months can get us to price out those hikes.
We have no strategy, no playbook from Warsh.
We really have no idea how Kevin Warsh thinks about monetary policy.
Chair Warsh does not want to communicate.
He listens to everyone, he finds a consensus, but he will set the policy out.
The statement could be pretty interesting this afternoon. Today, I think, will be important to listen to. What is the rationale? How is the committee thinking about the current state of the economy?
Consensus view, overwhelmingly no change. Conviction levels really, really low going into this one. 15 minutes away, your market looks like this. Equity slide on the S&P 500, negative. Down across the board on the S&P. On the NASDAQ, we're heading towards a 6th consecutive day of losses on the NASDAQ 100, the longest since October 2022. In the bond markets, 2s, 10s, 30s, yields elevated. It's been a feature of the year so far. We're holding on to these higher and higher levels. 460 on 10s, 430 on 2s, north of 5% on 30s. And crude is contributing to the move. WTI and Brent this morning higher off the back of renewed attacks overnight. Continues this afternoon, up by 7% on Brent, back in the 90s. The shock in energy, the shock in rates. The good news for this Federal Reserve, no growth scare just yet for this economy.
Yeah, the good news for that, as well as the latest CPI and PPI data, which is incredibly dated, was better than expected, a little bit more disinflationary. Does this give them a pause and a breathing space? Can I just say, everyone's saying that Kevin Warsh has a communication problem. It sounds like everyone's feeling very frustrated. There needs to be a market-fed therapy session, and maybe we'll get that today.
Oh, is that what this is today?
I think so.
I don't feel that. Bob seems pretty chill about it all. You're pretty chill about it all.
I'm pretty relaxed.
I'm pretty relaxed about it too, to some extent.
This is the way it used to be.
We're going back in time.
We're addicted to the modern communication.
TK, you'll understand this, though. I think the average age on a trading floor right now is probably around 35.
Exactly.
So if you've just lived the post-GFC communication story, this is not what you're used to.
Yeah, it used to be, Bob, you remember with Greenspan, did he have ham and cheese or, tuna melt?
Yeah.
It was that. It burns with the smoke signals and the rest. It alludes back to that. I like your idea of reaction function. And this meeting, the next meeting, third meeting, maybe we'll figure it out.
When you give me inflation data like that, it makes me feel how?
That was the big criticism of his news conference last time around. We can live without the forward guidance.
Exactly.
But what is the unwillingness to articulate the so-called reaction function? What is that about?
Yeah, is it actually something that plays into their hand because it introduces new volatility?
Subhadra Rajappa of SocGen joining the programme now. Subhadra, welcome to the programme. To Lisa's point, this should be straightforward. CPI was softer than expected. PPI was softer than expected. What makes this moment, just on the margin, slightly more complicated?
I think Bob really laid out the case well for why the Fed should keep policy on hold. The rates markets, of course, are looking at maybe a 30% probability of a hike today. But I would say that the rest of the markets, whether it be equities or corporate bonds or risky assets in general, I don't think anybody else is really, assigning any sort of a probability for any sort of Fed action. So uncertainty premium has definitely gone up in the market. You're seeing a greater volatility in market pricing of Fed policy actions. But broadly speaking, I think the Fed is likely to keep policy on hold. The risk, I would say, to hiking today would be that the market would quickly start to price in hikes at the September and October meeting, bringing forward that path of hikes. And that, again, I think would lead to a rout in risky assets.
Subhadra, there's an argument out there that if the Fed were to hike right now by 25 basis points, that would give credibility to Kevin Warsh, that would erase all concerns about political interference. Do you buy that thesis in any way?
Well, if he wants to stay away from political interference, then I think the best course of action would be for him to prove that he's independent and data dependent and cut and hike policy, given the fact that, yes, we've seen some soft inflation prints recently, but the trajectory for inflation for a good portion of this year has been trending higher. And in all possibility, if you look at the remainder of the year, we're expecting core PCE to continue to rise, perhaps top around 3.4% year over year. So in that sort of context, it would probably make sense for the Fed to think about hiking sooner rather than later.
Bob Michael, Subhadra is with an esteemed French bank. At what level is Mr. Warsh central banker to the world in this soiree?
So we've heard a lot of people say they would be surprised if they hiked rates today. I actually think if they hiked rates today, that would be the biggest central bank ambush since July 2008, when the ECB hiked rates, when the world was melting down under it. So I don't know that he's ready to do that. If he does that, he's not ready to be central banker to the world. Oof. If he takes the output of the task force, as he says, and balance them and comes out with thoughtful policy, forward rate guidance or not, communication, everything, then, yeah, he's ready for it. Right now, I think it's pretty much an unproven commodity.
You think if he hikes today, that hike would be as bad as the Trichet hike of 2008?
It's the biggest ambush since then. Not as bad.
OK.
Not as bad.
Because as you know, in 2008, and again in 2011, that ECB hiked largely because of what was happening with energy prices. Do you see a little hint of that this time around? Or is it more than just the move in energy, the move in crude?
It's certainly being led by the move in energy, but I think you also have to look to the broader AI spend. Suddenly, the world has to build something we never knew we needed before. And there's a lot of cost that comes with that. It's going to demand engineers. It's going to demand materials. It's going to demand energy sources. The knock-on effect of all of that is dramatic. It's going to demand businesses like us also invest in AI and how we operate our business. So I think there is a broader tailwind to inflation than just simply energy prices. But I think right now, energy prices are the focus of it.
Lisa said it early this week, and I think you might agree to some extent. It's provocative, but I think it's thoughtful, very thoughtful, that for this Treasury market, the reports after the close might be more important than what we hear from Kevin Warsh at 2:30 p.m. Eastern Time. What you hear for the CapEx intentions from the biggest companies on the planet, including Microsoft and Meta, might move this bond market at some point over time, more than this Fed. What do you think about that? Just the additional supply coming from them. How much it's crowding out the competition for capital, how compromising it's becoming for treasuries?
It's become a difficulty for the market to digest now. There's no doubt about it. We all know that the hyperscalers need to borrow, invest, build, and then deliver, and then see the revenue and profit come later down the line. But at some point, the market just gets a little weary trying to absorb it. You're also in the summer months. The demons are setting in.
Sure.
Everyone's questioning what's going to happen. I think it all works out well in the end. I think that the big borrowers are going to diversify how they finance themselves. So less doom and gloom. I think right now in the middle of the summer, it's created a soggy bond market.
Subhadra, I want to bring you into the conversation and get your thoughts on that. The competition for capital, do you think we're beginning to see the consequences of it in higher yields?
To some extent, you're seeing the crowding out effect of more supply coming from some of the hyperscalers. I would say, broadly speaking, as Bob is saying, I think a lot of the supply that's coming in the corporate bond market is very well absorbed. It's oversubscribed. So you are seeing a bit of indigestion in some of the names, but it's not a thematic for the rest of the markets. The concern, I would say, for the Treasury market and global bond markets is the trajectory for debt and deficits. Real yields are near the highs of the year. You're starting to see much higher global bond yields, and that's taking Treasuries with it. And then you start looking or thinking about defense spending, the general level of interest rates being about 50 basis points higher than where the CBO projected its deficits. And then you start to worry a little bit about what the net interest payment is going to be. And that, I think, is what's kind of pushing up term premia globally in bond markets.
That attention to the supply, Bramo, the auctions this week, just a little bit more attention here and there throughout this week.
You've seen credit spreads widen. Suddenly, equity traders start worrying about credit default swaps. That's always a new one. You start seeing that the actual spreads, particularly on tech firms, are widening more significantly than everywhere else. And you have to wonder whether suddenly the governments of the world have to really pony up in order to get some of those investors to turn their attention.
Yields today higher by 3 basis points on twos around 430, 10s around 460. Your decision about 5 minutes away. So, Badra, always fantastic to get your thoughts on the programme. So, Badra Japa there of SocGen. To add to this, Aditya Bave of Bank of America joins us now for more. Aditya, you're looking for hikes from this Fed, just not today. Why is today the wrong day to make a move?
That's right. Honestly, today, from our perspective, is a very close call. So we think Chair Warsh is in a difficult position. You can argue that this is exactly what he wanted, in the sense that the markets are responding to data and geopolitical developments without any guidance from the Fed. At the same time, if he hikes today, the question is why? As you discussed, the data in the intra-meeting period have been somewhat dovish. So is he just responding to energy prices? Didn't he tell us that the Fed shouldn't be responding to supply shocks? But then if he doesn't hike, that's a meaningful dovish surprise relative to where markets are priced. So is that appropriate? And honestly, would markets then conclude that this is the same old Fed? Similar to Yellen's Fed and Powell's Fed? Is this a Fed that only delivers dovish surprises? So I think either way, it's going to be a little bit challenging to message this move.
Aditya, if he doesn't hike rates, why is he holding a press conference?
That's a great question. Perhaps he's holding a press conference because if he had canceled it, then that would have been preempting the committee, because that had to be announced last week. So maybe the middle ground is to just have a very short press conference.
Bramo, you impressed with that response?
I mean, it's logical. At the same time, why did he introduce the uncertainty to begin with? So they always have a press conference and just sometimes hand out a memo and walk away, like Bob says.
How do you get away from this cadence of a press conference at every single meeting? We'll just go back to this world where we're just waiting for the one with the news conference and with the forecast, and we'll say they're not going to do anything in between, so just wait every 3 months.
He had no problem coming out and just saying task force about 150 times and then leaving everyone unsatisfied. He could do that again.
Would you be disappointed, Aditya, if he did come out in the news conference and every other answer was just about the task force?
It's not up to me to be disappointed or not. Honestly, he does not seem to want to answer questions about macro. His perspective, which he's entirely, it's his right to have that perspective, is that any questions about the economic outlook or the reaction function, answering that would be forward guidance. So given that perspective, if you're not going to answer any questions, then it's almost better to either not have a press conference or have a super short one, or as Lisa suggested, just hand out the statement and move on.
Bob, if we don't get more insight, do you think that that introduces more volatility in the bond market that's pernicious, that we're seeing translate into some of the bigger swings, particularly in high beta stocks?
Well, it's already happening. And Tom was talking earlier about tips break-evens. They've remained relatively moderate in the low twos, 2 1/8, 2 1/4. But when you look at real yields, they've gone up a lot. And that's pricing in the volatility that comes with Federal Reserve uncertainty.
That's the question. Does the uncertainty, the refusal to communicate, come with a price? Aditya, does it come with a price? And what is that price? Is it higher volatility? Is it high yields, higher rates? What is the price of reduced communication from the Fed chair?
That's the risk, that you end up building in a little bit more volatility at the front end. I don't think that's that big a deal, honestly. The risk is, do you start to build in risk premium at the long end, particularly if the market starts to say, okay, well, maybe this is a Fed that keeps talking tough, but ultimately doesn't deliver. So I think it's going to depend more on actions than communication. The risk here, given how much real yields have risen for this Fed, is that you can't keep fooling the market. Right? At some point, you have to either get lucky with the inflation data, or you have to deliver on the tough talk and raise rates. We expect them to hike 3 times this year, September, October, and December. But again, I wouldn't be surprised at all if they go today.
Let me be quicker, John, because we're getting to the release You had the key insight. We haven't talked enough about the process that he has to go through. There's all this pontificating and that. I get it. But the process now, September 16, October 28th, oh yeah, an election there, December 9, we pick up the pieces. This discovery of the Warsh method will also include him discovering it.
Aditya, it's good to see you. Appreciate your time. Aditya Bhavid there of Bank of America looking for 3 hikes. The first one's not coming today. He's looking for September, again October and later on this year. Is it just a communication exercise? If it's just a communication exercise, at what point does this market begin to push back just a little bit more?
If the data doesn't come in and cooperate. If you see a tick up in inflation and you don't see some sort of sense of why that is not enough to hike rates, then you'll start to see some of that skepticism be baked in.
How big would the shock be if this number that drops in about 40 seconds' time has a 4 handle? It's no longer 375 at the upper bound, it says 4.
At this
It'd
point,
be quite a surprise, wouldn't it?
You would have to imagine suddenly people would start reassessing just how many hikes there could be in this cycle.
Let's work through this market. The decision is about 20 seconds away. Let's start with equities. Equities this morning softening up. It continues into the afternoon. We're negative by 0.6% on the S&P. Some weakness in tech all week. In the bond market, yields elevated across the curve, up a few basis points, 2s, 10s and 30s. Your 2-year at 4.31. Yields higher by 2 basis points. With your Fed decision this afternoon, let's cross over to Mike McKee.
The news is sparse. No change in rates, 9 in favor, 3 dissents, Logan, Hammock and Kashkari. Other than that, there is not a word of difference between the June statement and this one. Economic activity is expanding at a solid pace, it says. Uncertainty is elevated, in part because of the Middle East. Productivity growth and capital investment are strong. Job gains have kept pace with the workforce, and unemployment has changed little. Inflation remains elevated relative to the 2% goal, in part reflecting supply shocks that have driven price shocks. The statement again concludes by saying the committee will deliver price stability. I think this is the shortest summary I have ever given you, and I've padded it out a little bit just to make it a little longer and feel like I've done something. There's no real surprise in here. You could point to the dissenters, but they've all said something about inflation and the fact that we might have to raise interest rates in the future. So it doesn't really give you a clue about what's going on, and there's no hint in the statement about what might happen in the future. So if Kevin Warsh wants the spotlight, definitely on him today.
Hey, Mike, I'll come back to you in just a second. Let's whip through the price action. So, as expected, widely expected, no change on this decision. Some dissent, not 1, not 2, but 3 dissenting voices from regional Fed presidents from the obvious places. The move in the market's interesting, though. Equities off the lows on the S&P 500, just erasing some of the losses so far this afternoon on the S&P 500. Still negative, but not as low as we once were, with the S&P negative just 0.3%. And we're getting some confidence in the tech trade, the Nasdaq down by 0.2. In the bond market, let's just sit at the front end of the yield curve. 2-year yields were higher by a basis point or 2, now down 4 to 4.25. So we often talk about this, Bramo, the difference between economist expectations and the risk that the market was pricing in. And clearly just a little bit of a gap there. Even with that dissent, some relief at the front end of the curve, a rally on 2s.
There truly was about a 30% chance of a Fed rate hike at this meeting, and that chance was not necessarily fulfilled. It is notable, though, that there were 3 dissents, and that, I think, is the news from this particular statement, given the fact that Neel Kashkari also joined Lori Logan and Beth Hammock. I was on a panel with him, and he was talking about this with a bunch of CEOs and saying this is a problem, and it is more pernicious for the average consumer in this country right now that inflation is so high than potentially the labor market is softening, because it's not. And I think that is something that you are hearing in the minority on the Fed.
The good news here for the leadership of Kevin Warsh, early days, quick reaction. The dissent came from the regional Fed presidents and not from the board. Because if it came from one of the board members this afternoon, I think we'd be having a very different conversation, TK, to the one we're about to have.
It's a market voting. Apple, $5.053 trillion, just out to a new record high, 344. Is a market voting here on their new Fed
I think
chairman.
Apple's voting on a lack of CapEx, and I think that's been a story on Apple.
Oh, yeah, I know that. I mean, I get that
week.
run. But, I mean, right here within the minutes after this announcement with the SPX popping up as well, I mean, they certainly like what they saw.
Well, let's take a step back and think about what's been happening in asset classes. We've had this massive move higher in energy and lots of volatility in between over the previous 5 months. You've seen that ripple through interest rates. We've priced out cuts and in many places priced in hikes, and in some places actually engineered rate hikes. What we haven't seen is a growth scare. The backdrop for growth is still pretty good. Consensus for GDP is still around 2. Unemployment's been falling closer to 4 and away from 5. That's good news. Now you've got a Federal Reserve that doesn't still see a reason, even with that as your backdrop. They don't see a reason to hike interest rates right now today. Some do, but not the committee as a whole. If you're looking at that from a risk asset standpoint, Tom, that's risk positive without a doubt.
It is. I mean, they're moving forward, and to me, the key thing after Jackson Hole is to get to that next meeting. All of a sudden, Jackson Hole may be interesting.
Oh, I definitely think it's going to be interesting. We need to hear about insights from task forces. That said, right now, I do think
you know
that's
how much I love the task force.
I think that they're going to be important. To me, this is actually a fascinating statement. Does he set up a September rate hike with the idea that there are 3 dissents and potentially there is another CPI and PPI print that will be potentially hotter than expected?
Neil Dutta Ranmack, always early to publish. He says the following: I think the dissents tell you the direction of travel. It will be very tough for Warsh to hold the line into September. I hope Mike McKee's holding the line just before he goes into that news conference in about 25 minutes' time. Mike, given the lack of new information here, beyond just the dissent, what's your approach to the news conference at 2:30 Eastern Time?
Well, I think we have to ask very direct questions of the chair. We can't ask him broad questions like, what is your reaction function or something like that, because then he's going to just elide those questions and we won't get good answers. So we'll have to pick out some things like where we are with rates. Are those sufficient at this point? Something to try to get him to give us some specifics on how he's thinking. But I think what you guys have just gone through is what he's looking for. He'd rather have you speculating, markets speculating, than give you a hint. And nature abhors a vacuum, so the markets are going to fill it with what they think might happen. But it's going to be hard for anybody to really know unless Warsh wants to start tipping his hand, which it'll be a battle between us and him, I guess.
Looking forward to it, Mike. Thank you, buddy. Get inside that news conference. Mike McKee will go into that news conference for us. It will begin at about 25 minutes' time. If you're just joining the programme, welcome to the programme. So unchanged to the Federal Reserve, but the vote is different. It's 9-3, and the dissenting voices are as follows. Bottom of the statement, Beth Hammack, Neil Kashkari, Laurie Logan. Dissent coming from the obvious places. All 3 of those voting for an interest rate hike. At the bottom of the statement, that line sticks. The committee will deliver price stability. We've got Bob Michael of JP Morgan Asset Management alongside us. Bob, is that line in the statement enough for us not to question their commitment to price stability with inflation running above target for as long as it has been running above target?
I think the 3 dissents are more important than that last statement. I think that it shows that they're starting to migrate towards tightening policy. You know, there's still 75% of the voting members that were in favor of no change. So you're only at 25%, but I think it's important. If I were at the press conference, I'd ask about quantitative tightening. Are they talking about that? Is that something they could start up again and help snug the liquidity that's in the system?
Best guess for September. Limited additional information, but best guess for September. What would you call now?
They do nothing, but maybe there are 4 dissents.
Bob Michael is going to stick with us. Going into that news conference 25 minutes away. Joining us now is Jim Bianco of Bianco Research. Jim, welcome to the programme. It's a whole new world, a new era for this central bank. You've been writing about it extensively. Just first of all, your reaction to this decision this afternoon.
Not surprised by the decision that the Fed did not raise rates. I still would defer with Bob and think that they are going to raise rates in September. I think the dissents are the most important thing, because one of the things I've been emphasizing is after Trump attacking this Fed for 2 years, they want to be independent. And they've decided that independence is 12 independent voters. So what we're going to get at the press conference is 1/12 of the opinion of the Fed is we're going to get Warsh, or maybe we won't get it at all if he doesn't express it. Now, he's got a lot of power. He could probably twist some arms to get them over the line, whichever way he wants to go. I suspect that if they were all voting their true conscience, we might have had a few more dissents, maybe not enough to raise rates, but a few deferred because he didn't want to do it, would be my guess.
Jim, do you think it's significant that none of the governors joined with the dissenters, even though there were some reports of some pretty interesting family fights over dinner last month?
Mildly. I was expecting that maybe Chris Waller was going to be a dissenter. He still might be a voter for a rate hike in September, maybe a couple of others. But I do want to emphasize again, we're going to parse every word that Warsh wants to say. I think that the Fed is more of a vote tallying exercise right now. You know, you got to look at all 12 people and say, which columns are they in, high, cold, or cut? And 7 is a majority, and which column has 7? And that's what the Fed's going to do. That's how they work now.
Bob Michael, the young whippersnapper Jim Bianco a couple years ago had an arch call calling for higher interest rates when no one was looking for it. The other day, Ed Yardeni said, these are normal rates. We have to get used to rates being here again. Is Dr. Yardeni and Jim Bianco correct? We just got to get used to these higher rates?
Yeah, I think what we're seeing more broadly across the economy is a need for CapEx. There's demand for capital, there's a productive use of it, there's going to be competition and a cost of it. That's pre-GFC kind of macro environment. You're not going back to 0 to 2% rates. Do I think there's enough cause for them to hike in September as opposed to next year? I don't think inflation is going to change that much.
I can't remember, John, if you're on or off here, but you said this 20 minutes ago. What percentage of people in the street actually remember pre-GFC?
We were very live. And I remember what I said. I talked about the average age on the trading floor, which is probably mid-30s right now. So the world that they're used to is not the world that Kevin Warsh wants to take us back to. It's also not the world that we've experienced in financial markets either. To your point, we had these anchors across fixed income for the last 10, 15 years. Lisa and I have talked about them daily, how they're disappearing. Germany had fiscal prudence for decades. That's disappearing. Japan had disinflation, deflation for decades. It's changed. And in America, the biggest companies on the planet were buying themselves, not issuing stock, not issuing debt. That's changed as well. The price of that, Bob, what is the price of that? And what part of this market is most vulnerable to that competition for capital?
It feels like it's the sovereign market. I don't know a sovereign which isn't interested in investing in energy security, in investing in the defense of its borders, in investing in AI and technology more broadly. They don't have the budgets to do it. They're going to have to go out and borrow. That's going to create more competition for the capital. That's okay. That's a normal capitalist environment. We're okay with that, but it doesn't mean 0 to 2% central bank rates and Treasury government bond yields is the right level. It means probably neutral rates for the Fed are around 3 to 5%, and you're looking at a 10-year Treasury that, who knows, could be 4 to 6%.
In this world where suddenly you have to battle for capital, and Jim, I'd love your take on this, is it a policy error if Fed Chair Kevin Warsh allows the move to stick that we're seeing right now in markets? Now there is not a full rate hike being baked into September, and frankly, the initial move has given back at least at the long end of the yield curve. Do you think that it is important for this Fed, whether it intends to hike or not, to keep the message that they are prepared to do so to tame inflation?
I think so. If you want to back up, go back to September of 24. That's when the Fed first started cutting rates. The 30-year yield was 4%. It was exactly 4%. Right now it's 5.10. It's gone up 110 basis points while the Fed has been cutting rates. By my measures, I can't find another example of a rate cutting cycle that produced that big a yield increase in the long end since the 1980s. But then again, we also had 14% interest rates then. And without that, never in anything back to the 1950s. So really, the market is trying to tell you that I think the direction of travel is going to be higher. It's more worried about inflation. And if go back to that last sentence, if the Fed wants to deliver price stability, I'll throw one other into you. Kevin Warsh said that inflation is a choice. They might have to choose to do something about it fairly soon, and maybe as early as the September meeting.
Jim, if they do something about it, do we continue with this robust nominal GDP we've seen?
I think we can. And I also think if the Fed were to raise rates, that might put the high in yields for the year. I think part of the problem has been that now that we don't have forward guidance, the market is pricing what it thinks. And I think it thinks there's an inflation, let's say, issue or worry. I don't want to go full-blown problem or crisis. It's not that bad yet. And that's why yields keep going up. And I think it would like to see the old line, the old adage on Wall Street I've been using is that bond traders can relax or stop panicking when the Fed starts panicking, and maybe a little bit of panic from the Fed might go a long way to helping the bond market stop with this yield rise on the long end.
It's a valid point. Jim, appreciate your time, buddy. As always, Jim Bianco there of Bianco Research. If you're just joining the programme, welcome. A news conference with Chair Warsh in about 17 minutes' time. The decision 13 minutes ago, leaving rates unchanged, a vote of 9-3. 3 dissenting voices, 3 regional Fed presidents. Hammack of Cleveland, Kashkari of Minneapolis and Logan of Dallas. 3 voices who have given us a decent steer that this might be the outcome of this meeting, at least for them. Next 2 weeks might be interesting. I think we're all going to look for that schedule, aren't we? Those speeches, what everyone thinks. And this was always the problem for this Fed chair. Looking to put communication back in a box, back in a bottle and throw it away and bury it. Everybody else still wants to talk. And if you speak less, we just put more weight on the people that do speak, and that's what we'll be doing in the coming weeks.
It's going to be a vote tallying exercise over the next 2 weeks, with people watching every single press conference, every single speech, and wondering who is going to be the additional voice to vote for a rate hike and how close are they. And that is ultimately the calculus that we're going to see. Kevin Warsh could potentially put that back in the bottle if he gives us some sort of quantification or characterization of what the reaction function is. But barring that, we're going to be doing vote tallying, and we're going to have a bingo card, and it's going to be a lot of fun.
Can we go from 3 to 4 to 5 to 6, etc. to 7? Diane Swank of KPMG joined us now for more. Diane, welcome to the programme. Do you believe this is the direction of travel? This is the first of many votes that will look for higher interest rates.
Absolutely. I think the 3 dissents from the presidents is what exactly we should expect right now. And those dissents were not done in a vacuum. They also are representing presidents who could not vote at this meeting. That is often what is done. And I also think many people on the board are leaning towards a rate hike as well. We've already gotten a lot of indication of that. And so I do think we do get rate hikes in September. I actually think today would have been better, but I expected them to skip today, even though there was a 30% chance out there that they would do it today, because we're starting to get, this is something that Kevin Warsh has said himself. We've had 5 years of inflation. It's not all the Fed's fault, but at the end of the day, it is the Fed's choice, as Jim pointed out, to do something about it. And we need to do something about this inflation. It has been around for too long and created a muscle memory. It's becoming the norm instead of the anomaly. And tomorrow we're going to get that PCE data, which the reason why Beth Hammack sort of threw down the gauntlet and wrote the LinkedIn post hours before the Fed's blackout period, letting us know exactly how she felt about rates, was because they were tracking the inputs on that number, and it will be 3.3% on the core, and on the super core, I think 3.7% super core services. That is sticky and hot, and hotter than it was at the beginning of the year.
Bob Michael had a really good point earlier. He said it kind of depends why they hike. Is it going to be that the data shows a reacceleration, or is it just that they're running out of patience? And if they're running out of patience and tolerance of high inflation after more than 5 years, that typically isn't a great place for a central banker to be in. Would you agree with that?
I do agree with that to some extent, although I think we still got a little more inflation out there as well. But the problem is that it's just been too persistent. This is too much for too long, and it's compounded. Much like I've argued, compounding stock returns have raised the level of wealth. Compounding inflation has risen the level of prices to be too high for too many. And that being front and center is not the definition of price stability. And that is what the Federal Reserve is charged to do. And with the labor market in a stronger position, there's no reason not to do it now.
Well, Michael, I'm not going to go to the one with sterling academics at Michigan in economics. I'm going to go to the classics major from Pennsylvania. Is it a small matter that the 3 dissenters are an aerospace engineer, educated, a public policy, Lori Logan, educated, and Beth Hammack at 21 was on the desk at Goldman Sachs? Is this almost a dissent rebellion against traditional monetary economics?
It may be more common sense than anything else. I think, as Diane pointed out, you've been a long way away from the 2% target for a long period of time. There could be a little bit of disinflation in the system. I wonder what happens if the next couple prints on core PCE, you go from 3.4 to 3.3 to 3.1. And you see you're still above 2%, but what about on core CPI? You go from 2.6 to 2.5 to 2.3. You're still above 2%. I think dissents reflect that, hey, we're not at our target. If this swings around the other way, we're poised to move, but you don't move yet if you're starting to see some disinflation.
Can you talk about Goldman, the Death Star in front of JP Morgan? Can we do that?
No, but that's where Beth was. She was 21 years old on the desk, and nobody dissenting, John, did the usual economic path.
Let's go to that Hammock
find that
dissent.
remarkable.
Let's go to the quote of hers in the LinkedIn statement going into the quiet period. The lead up to this dissent. There is no conflict in our mandate. Inflation is too high. The labour market is right around my level of maximum employment for the first time in my tenure. I'm hearing from businesses who say they think we need to take action to curb inflation. Dan, that's pretty punchy stuff. And when you said that dissent might be on the behalf of others on the committee who don't get a vote, how many regional Fed presidents are hearing the same thing from their districts across this country?
I think they all are, and I think that's the important, sort of what we're seeing out there. We are seeing many people across the country. It's showing up in the Beige Book as well. It's showing up out there that firms still have some pipeline, even on last year's tariffs. So the new tariffs, they're reinstating old tariffs. That will add a lot of extra tariffs out there. But we also have Russia sanctions, which allow up to 100% tariffs on some of our trading partners at the discretion of the president. So those are going through Congress right now. All of that is more choke points, more shocks at the same time that we still have this persistent underlying inflation that's just not going away. And to think that it's going to go away on its own when we're seeing things like in the wages in the leisure and hospitality sector, which shed jobs last month, wages actually accelerated. That's something to watch. That's the service sector. That is where we're seeing that buoying sort of effect of wages, also the costs holding up that inflation. That is something the Federal Reserve is very concerned about. You want low-wage workers to get more pay, but only if they get more pay that's above and beyond the level of inflation.
Bob, I'm struck by the neutral rate. We haven't talked about it once, but given the sort of competition for capital that seems to be going on globally, is it possible just that the real rate has to be a whole lot higher than people previously expected? And frankly, we're seeing that in the lack of any kind of erosion from demand?
Remember when the Fed first started doing the dots in 2012 because they didn't think we in the markets were smart enough to know what normal looked like again. So they were going to help us out. And you go to that long-term median dot, which was perfect textbook. It was 4.25%. How did they get there? Over the 100-odd-year history of the Fed, the real Fed funds rate had been 2.25%. What were they targeting? 2%. You put the two together, there's your fancy algorithm, 4.25%. Wouldn't it be funny if that proves to be correct over the next decade?
I look, John, at where we are with this, and again, we got to get to the next meeting. This press conference to me, I mean, to Bob, it's gone out on Twitter, what Bob said about what are we going to see. We have no clue what we're going to see here.
Zero.
Zero.
It's totally up to him.
Will he be on time?
I mentioned to Mike, I hope he will be. I mentioned to Mike earlier on this morning when we were on Bloomberg Surveillance, and I said to Mike, as a journalist, you have to change your questions because no one wants to be the journalist in the news conference that gets a two-word response and it involves task force. No one wants to be that guy. So what are the kind of questions you need to ask Kevin Warsh that maybe you wouldn't have thought of asking Chairman Powell?
Yeah, well, what Mike said was you've got to be very specific. And I liked his question about specifically how are you thinking about oil? Because right now you could say a lot of the inputs to inflation are supply shocks. How do you consider supply shocks when they are repeated supply shocks again and again and aren't likely to stop being shocks considering the fact that this conflict isn't going away anytime soon?
Dan, you're great at this. Final question. What's your question for the Fed chair? You've talked about a new chair, an old guard. What's your question for this guy?
I guess my question is really on that neutral rate, exactly as Bob outlined. I think we're actually lower than the neutral rate right now, and I think many on the Fed believe that we're lower than the neutral rate, or at least at the neutral rate, which is not where we should be if inflation is at this level.
Dan, appreciate it. Dan Swank there at KPMG. It's such a good point. There's a phrase that you heard a lot, I think, over the previous year or two when they were cutting rates. They talk about being sufficiently restrictive. How many times have you heard that in the last 6 months, being sufficiently restrictive? I haven't heard it at all from a single Fed member.
Because guess what? The evidence doesn't back that up, that they're sufficiently restrictive, because inflation moved in the wrong direction. And increasingly, people are saying that the 3 insurance cuts last year were a mistake, and that actually fueled some of the incredible run-up in some of the memory chip names.
Victoria Fernandez of Crossmark joins us now for more. Victoria, welcome to the programme. Is it time to take back some of the insurance we took out last year with 3 cuts and the year before with interest rate cuts then too?
You know, Jonathan, I actually thought that's why we might actually see a rate hike today, and that was going to be the explanation for it. Not that they were concerned about longer-term inflation. They were going to be looking through the Middle East, through oil, all of that. I think that the concern was going to say, or the explanation was going to be, we're just taking off some of that accommodation from last year that wasn't really necessary. I wouldn't be surprised if that's part of the explanation they use at the September meeting, if they decide to hike then. But I definitely think it's part of that story. It's part of where is neutral rate. It's part of the concept that maybe we are not as restrictive as a lot of people think we are. All of that goes together to tell us we probably have a rate hike coming.
Victoria, you're in the heart of oil land in the United States. You're in Houston, and there's a huge boom going on. I'm looking at the earnings coming from the oil sector, and they're doing wonderfully. It's been both, yes, penalization for some consumers, but on the flip side, it's only adding to some of the robustness that oil prices have gone up to such a degree. How much do you agree with what we've heard from some regional Fed presidents, which is that companies are asking for action as they see both the momentum increase in tandem with prices?
Yeah, you know, Lisa, it's an interesting topic because you always have people when oil prices come down, they want to know why they're not, you know, moving fast enough to bring oil prices down. And yet at the same time, they want to know why these oil companies aren't investing more cash. Why aren't they drilling more? Why aren't they doing more things? And they have to have the free cash flow to do that. And I know their balance sheets are really strong right now. Energy is the best performing sector that we've seen so far this year. So I think there's an element here that the energy companies are really kind of sitting on their hands a little bit because they know that when the Middle East conflict is resolved, they're going to see that drop in prices. Look how quickly we saw prices come down almost, $25, $30 a barrel for Brent and WTI when we had the memorandum of understanding, and we've seen it go back up in the last few days. I do think there's going to be a lot of volatility here. Earnings are actually expected to come down the rest of the year when you're looking at the energy sector. So I would be careful here. They're doing really well right now. I think it's a great long-term holding to have in your portfolio, but I do think the energy companies are going to be a little bit cautious here.
Victoria, look how limited the rally was in bonds when we had that correction in crude. It tells me that the outlook for rates is not that dependent on the path for oil. Is that a fair assumption, a fair conclusion?
I think it's a pretty fair assumption, Jonathan, because actually I think what the bond market is looking at is saying, wait a minute, yes, we have this oil component, and it's making the headline numbers come down quite negatively when we're looking at inflation reports. But the core and the super core, where it's not included, we're actually seeing some still moves higher in those elements. So to me, that's the key question to this Fed. How are we going to measure how much some of these shocks that you want to look through are actually seeping down into the economy as a whole? They say the economy is expanding at a solid pace, but how long if we keep seeing pressures come in at that point? So I think the bond market is more concerned around that, more concerned around deficit spending, around money supply, not so much around oil price changes.
Victoria, it's good to see you. Appreciate your time as always. Victoria Fernandez there of Crossmark weighing in on this Fed decision. Equities this afternoon still negative by 0.5 on the S&P 500. In the bond market, 2s, 10s and 30s shaping up as follows. 2s, yields down just a single basis point right now. 2s around 4.28. Framing matters. These three dissents, what is the character of each individual dissent? What will they say in the coming weeks in their statements? Is this about taking back the insurance they took out last year and the year before, or is it more than just that?
Well, they have all indicated about taking back the insurance from last year, and they've all talked about the price pressure that consumers are feeling and that they're hearing even from companies. That said, my question is about the others and who's going to potentially join them at a time of incredibly volatile inflation. And is the volatility in inflation enough to actually get them more concerned that they need to make a move and take a step there?
In defense of Chairman Warsh, we're all going to be waiting on the data now. I mean, the data is incredibly important through Jackson Hole onto the next meeting.
The curious case of this particular meeting, TK, is that we looked at the data and it was softer than expected on CPI and PPI. And there was a feeling that we would move on. And we sat around this table at the time when the data dropped on Bloomberg Surveillance, on Bloomberg TV on that very morning. I sat there with you and we both said the same thing. It removes the urgency to hike. It won't kill the story. The debate continues. And the debate does continue even this afternoon. And now we're talking about September. And maybe September's the date. And this is the direction of travel. Story just won't go away.
Take a look at earnings. Earnings have been on fire, and it's not just in the tech sector. It's across the board. The equal weight's outperforming also because of a fundamental kind of bleed up. And
regional banks in this country.
I mean, really, it's something that's
almost
more significant. So sufficiently restrictive. If you're looking to crimp growth in any capacity or looking for a slowdown, it's not happening.
Bob, I was going to say final word, but you might be sticking around. I have no idea how long this news conference will be, but give us a final thought on what you'll be looking for through what is not a sleepy summer.
I think the Fed got it right today so far. We'll see if there's a press conference and what gets said or not. I'm particularly glad with the fact that they've listed the 3 dissenters. Let's assume that the vote had been 7-5 in favor of a rate hike. By listing the 5 dissenters, we would know the 7 people who voted for a rate hike, and we'd sit there and go, we got 2 or 3. Where did the other 4 or 5 come from? What were they looking at? They didn't say any of this 2 weeks ago. What changed their mind? Is it all emotion? And I think that's a great regulator to a central bank and prevents them from just acting on emotion.
Bob Michele of JP Morgan Asset Management. Bob, thank you. Might be back with you in 5 or 10 minutes' time. This news conference is about to begin in about 60 seconds from now. A newly minted Fed Chair, Kevin Warsh, will appear for his second press conference, widely criticised last time around. Not for his refusal to offer forward guidance, that's gone, we've moved on, but his refusal to articulate his so-called reaction function. I think 3 dissenters at the Fed have been pretty clear about how they think about the incoming data and where they think policy should be.
I think Mike's question earlier is a really important one. How do you consider oil, and how potentially does the increase in prices affect your view, considering it does tend to be a one-time shock? But when you have rolling shocks, there is another type of dynamic that takes hold, and that is what we've seen.
I'm not a big gambler. In fact, I'm against betting. But I will ask this question. How many trading floors right now do you think are taking bets about how long this news conference will be? With Kevin Warsh?
I think that's the question. I think we're taking bets right now because we're trying to figure out for programming reasons who we're going to have to book afterwards.
What's your number?
I think it's going to be. I think it's going to be 45 minutes.
And seconds, Bramo. 45 and how many seconds?
45 and 32 seconds.
TK, you playing this game?
I'm not playing this game, but
okay,
I can just imagine Kelsey Barrow at JP Morgan with Kay Hair. They're all around the terminals, you know, betting here. They're probably in one of the 14 restaurants.
Kelsey's running the book at JP Morgan.
Yeah, I think she's running the book. They're probably in a bar over at their new skyscraper.
The man himself walks into the room. Kevin Warsh, Fed Chair, in front of the podium following an unchanged decision, but with 3 dissents. Let's take a listen.
My second FOMC committee meeting as chairman has come quickly. It's probably too early to call it a streak, but our discussions again were collegial and constructive. I'm truly lucky to work with colleagues so capable and mission-focused, and so determined, like I am, to sharpen the performance of the Federal Reserve. Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting, a choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. Two economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades, ranking around the top decile or so. But if the committee didn't change its policy rate, what happened? In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal. And where necessary and appropriate, we will not hesitate to act. A second economic development is one that I noted at the congressional oversight hearings this month, but it's worth repeating. The most striking feature of the economy is the strong growth of business investment. The surge in high-tech CapEx has been remarkable, but that does not necessarily make the Fed's role any easier. In the AI-related category of high-tech equipment and software, the most recent data shows 4-quarter growth rates of nearly 20%. This is helping to sustain the healthy momentum of manufacturing output. More generally, CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. FOMC meetings produce policy decisions, but just as important is candid discussion of the big things that matter most. That too is a priority in this new chapter at the Fed. In our meeting, vigorous discussion centered on 4 questions, which I will enumerate. First, we talked a lot about the implications of the past 5 years of high inflation on the current policy conjuncture. To echo an old phrase, has the past really passed? Second, my colleagues and I considered the economic shocks of recent years, strained supply chains arising from the pandemic, military conflicts, energy supply disruptions, substantial increases in tariff rates, and yes, the surge in AI-related investment. These differ in their sources. Do they also differ in their effects on output and employment? Third, we took up the related question of price increases arising from shocks. The business CapEx boom, for example, is driving up prices of memory and logic chips and associated AI infrastructure. Do these changes indicate a broader inflationary dynamic, or do we just focus on them because they are under the bright streetlight? Finally, we discuss monetary policy tools and strategies for achieving stable prices. If, as the Fed has long held, interest rate policy should be its primary monetary policy instrument, how much accommodation are we getting from the balance sheet? In all of this, our work is advancing at the Fed. We're asking the right questions. And in this consequential time, we know how very much depends on getting the right answers. Of course, you've all arrived with questions of your own, so let's turn to them now.
Let's start with Steve.
Thank you for taking our questions, Mr. Chairman. Sure. You've had a couple months now, or 9 weeks, or whatever number it is, to see the markets behave in the absence of forward guidance. I'm wondering if you could tell me, what message are you getting from the markets as to where policy ought to be right now?
Yeah, so I think officially it's 8 weeks and 4 days, but I'm not counting. The message from markets is the message from markets. What I've really been trying to do, Steve, as I think you appreciate, your colleagues appreciate, is getting an unfiltered message from markets, getting a direct message. Letting buyers and sellers meet at prices for treasuries, for the foreign exchange value of the dollar, and then trying to judge for ourselves, what does that mean about our remit? How are we doing on inflation? How are we doing on employment? We're trying not to interfere with that market signal. That's part of the reason why we've been somewhat spare in our words, why we pulled back from forward guidance. So they're reacting to events, I would say, much more directly over the 42 days since we last met. This is a good thing. As I mentioned in the prepared remarks, we've seen a material tightening, not just in nominal rates, but in real rates too. And we're observing it. We're trying to stay out of that because, many of you might be interested in our reaction function. We're interested in the reaction of financial markets.
I get that, Mr. Chairman, and I guess the follow-up question is, if the markets are talking to you, what do you hear them saying? And if it's real rates are higher, it would suggest that that's where the funds rate ought to go.
Yeah, so
sorry.
I'm sorry, it's your question. So interpreting markets is an imperfect business. We central bankers, like market pros, can think these things are over-determined, but let me offer some speculation. First, as we said in the FOMC statement that you got at 2 o'clock, the economy output is solid. CapEx and productivity are strong. Labor market's solid, steady. The bond market, the treasury market, it seems to be saying that as well. If I were to try to break down, disaggregate the treasury market signals, I wouldn't be able to do it perfectly. But the bond market's saying many of those same things, and that's why we're seeing a tightening both in nominals and in reals. Even while at some level we haven't done much in 42 days, the markets have done quite a bit.
Claire Jones, Financial Times. You seem to have got the family fight you were after at this meeting. We saw three dissents. Could you characterise the arguments that those dissenters put forward, please, and tell us a little bit why you weren't persuaded by them at this stage? Thank you.
So I guess I shouldn't give you their best arguments. I'll give you some others. So you're right. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. My view, which you've long heard, is that's the better way to get policy right. That's our North Star. So there was a lot of agreement that I heard that we have the powers, the tools, also the authority to deliver stable prices. No walking back from our responsibilities. There was a large majority support for the decision that we made in the room. But I also want to leave you, Claire, with one other impression. There was nothing inertial about that discussion. It was an active, robust discussion about what's in the full range of what we can do and might want to do in the period ahead. You characterized accurately there was a disagreement about a decision today. I would say that doesn't sort of capture the full essence of the discussion. The path to central bank heaven requires delivering on our remit. These days, that means delivering on price stability. I wouldn't measure that path in 42 days or any one particular meeting. And I came out of that meeting even more confident that this is the right team to win the battle against high inflation.
How much do you think not going in July was down to the cool CPI print for June?
So in 2 words, not much. Not much. I'd like to believe that the committee shares my views, which is the historic problem with data dependence is the data and the dependence. We are not relying on any one individual piece of data as cover or as an excuse or as validation. What I care about and what I think the committee cares about is trends on the data. Sure, we got some encouraging inflation data. I think at the meeting 42 days ago, I said something like 63 months of inflation above target. I didn't say 64, though the final calculation might be a close one. So we'll be watching inflation data over the period ahead. But I also don't want you to leave the misimpression that we're sort of breathlessly waiting that. I've called for a task force to revisit both the private and public data we use to make our decision making. That task force is out doing their work. I'll be checking back in with them the next couple of weeks, but I wouldn't say we overly relied on any one piece of data, including that data, which surprised some a couple of weeks ago.
Hi, Chairman Warsh. Thanks. Neil Irwin with Axios. Thank you for taking our questions. So the Fed funds rate is now about 75 basis points below the 2-year yield. Suggests markets think you'll have to tighten eventually, about 100 basis points below most Taylor rule estimates. You're hitting your employment mandate. Inflation stays high. Why should rates not be higher today?
There's a lot in there, Neil. So rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean we take them as by dictation, but we're observing them. So I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make. I'll see if I can put it this way. Monetary policy matters not just by what we say or even what we do. Monetary policy matters by how it affects the real economy. And these prices that we see in financial markets is one of the many ways in which it affects the real economy. We'll be continuing to watch that market information, see how it responds to incoming events, and that can help inform our decision making when we meet in 7 or 8 weeks.
How would you characterize in the family fight the last couple of days of you and the other 8 members who wanted to hold? Was that a strong conviction or was that a hair trigger close call on holding versus tightening?
Well, I think the vote was 9-3. The broader discussion to my ear over the course of the last days showed a lot of agreement on the hard questions. The 4 questions I raised at the outset about what's really happening in the economy with the shocks and absent the shocks. What are our tools and our capabilities? What's the effect on prices on output? I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. So could people come to different conclusions? Absolutely. But my own judgment is this is a period of watchful thinking, not watchful waiting. And I think the score on that vote was unanimous.
Thank you. Colby Smith with the New York Times. You've mentioned that looking at the Fed's policy tools is one element of a 3-pronged strategy to address the inflation problem. So I'm curious how you view the effectiveness of those tools. If inflation is too high and not coming down, is the best remedy to raise interest rates?
So that was the discussion in the last 2 days. Is that the dominant remedy? If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. but I wouldn't say it's in isolation. I tried to describe in my remarks today a point that I made to the oversight committees a couple of weeks ago. I think there was a misimpression by some in financial markets, by some households and businesses, that central bankers like me, we set a 2% inflation target, but maybe we were more tolerable of a somewhat higher inflation target. In economics, we'd call that the revealed preference. And so might it have been rational for people to think, well, their inflation target's somewhat higher. What I heard in the last 2 days, what I've heard in 8.5 weeks is no. We will deliver the 2% inflation target. That is the committee's definition of price stability. So one way, absent the tools that you reference, to ensure that we get there is ensure that expectations are centered around the right number. And I think we've made some progress on that. I am not suggesting we're done on that. It's worth reiterating. And ultimately, the business we're in, Colby, is performance. We are going to be judged by how we perform. And that's what we intend to do. The inflation target, making clear expectations is one part of it. Making sure we demonstrate we're responsible for it, we're not blaming as another. And our policy tools, like you referenced, is the third and equally consequential part.
How are you factoring the fact that a large portion of the inflation overshoot is being caused by supply shocks, as it's mentioned again in the statement? Does that blunt the effectiveness of rate hikes in your view?
First, on the premise of your question, it was almost as if you were listening to our discussion in the last day and a half. A lot of our focus was on trying to understand and identify underlying inflation dynamics amid shocks. We take these shocks seriously. There have been a series of them that have been hitting this economy. We're not looking through them and saying, oh, they don't matter. But we're trying to understand is to what extent are these shocks broadening in their effects, broadening in their impact on prices that are quite far removed from it. Our goal is to have growth that is broadening and inflation that is becoming more limited, more circumscribed. I'll be the first to admit the shocks make this job and this policy conjuncture a little tougher, but that's among the chief questions we've asked ourselves. And around the room, people have different views on it. I tend to think in the coming months we're going to refine that view and have a better judgment, and we're going to have market prices trying to help inform it too.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. I guess I want to drill down maybe a little bit. What specifically, in your mind, would be the argument then for a pause today?
So I wouldn't characterize what we did as anything like a pause. I would characterize what we did as a rigorous review of the economic situation. I would characterize what we did as a review of the big, hard questions. And I'd characterize it as a view of what our own homework is to try to resolve those questions in the period ahead. If you were to try to force a description that this was a pause, I would say financial market prices would take the other side of that. Financial market prices in this intermeeting period, they didn't pause. They reacted to the inflation data in one direction, strong economic growth in the other direction. And nominal and real rates went up. Did the Fed take an explicit change in its policy rate today? No, but I think that's the beginning of the story, not the end of the story.
And if I could, I did want to ask, not forward guidance, but looking forward. Traditionally, a Federal Reserve chairman uses the Jackson Hole summit as a sort of a reset of monetary policy. Well, how do you look at the speech that you're going to make in August?
I look at it like a blank piece of paper right now. I have not begun consideration with the incredible team here what would go into that document. I think you characterized it correctly. Historically, at least from my first tour of duty at the Fed to more recent periods, it would be sort of a setting up speech more often than not of what was going to be happening in the fall. I haven't made any judgments on that, but those are judgments we'll have to come to. If I could, in the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic. Did you do this by a quarter or do that? Ultimately, whether we deliver on price stability matters some, the decisions we make in 6 or 7 or 8 week periods, but they matter more. What are the big questions? What's really happening with productivity? What's really happening with demographics? What's really happening to the global economy amid the shocks? Haven't made a decision whether it's going to be a big picture speech or whether it's going to be a more traditional setup for all the action we're going to have between September and December. I will tell you one other thing that I am doing between now and Jackson Hole, which is I'm checking with those task forces. My first principle of establishing a task force is find the best subject matter experts anywhere in the world and put them together, especially put them together with other people who might disagree with them. In the next couple of weeks, I'm going to be doing a check back in. I've given them time to sort of think hard about their agenda, their debate, their schedule, and when they might be ready for prime time. I'll be doing a little bit of that checking, and that may or may not inform anything I have to say in Jackson.
Nick Timmeros of the Wall Street Journal. Chairman Warsh, I want to follow up on Colby's question about policy transmission. You've said there's no cruel choice between stable prices and full employment. Rates bring inflation down by cooling demand. It's generally thought that can show up in the labor market. If that's not the channel you're relying on, what is?
Yeah, so let me go back to first principles, Nick. I don't believe that either part of our mandate is generally at war with the other part. I do not believe that price stability and full employment is an either-or proposition. There have been policymakers over the last several generations who have thought that there is a strict trade-off there. That isn't my judgment. In fact, my judgment is if and when we deliver on our remit, we're going to be satisfying both prongs. We're going to have price stability and full employment. And in fact, if you want to do the most harm to the labor markets, you would run a period of high inflation that's variable such that employers, businesses, wouldn't really know what's going on. So I think the two parts of our mandate are equally important. We have no legislative orphans here. I've been talking mostly about price stability because we're doing pretty well collectively as a country, as policymakers on the full employment side. But we're doing considerably less well on prices. That's why we describe them as elevated, and that's what's taken most of our discussion. In terms of transmission mechanisms of monetary policy, I think different tools work through different transmission mechanisms. The interest rates work through lending channels and credit channels, maybe confidence channels and foreign exchange. The balance sheet probably works through some other channels like signaling and portfolio balance. We're keeping full abreast of all these tools in making policy. But if the suggestion is somehow we're going to be fine-tuning aggregate demand so it catches supply, that's not my mental model. I don't think we're great in the fine-tuning business. We're trying to get supply and demand in broad order, but really what we're doing as we sit here today at this press conference is I think we've got a reasonable sense of what aggregate demand looks like in this economy. We're inferring aggregate supply. We're making a judgment about what productivity is. And in some sense, there's a race between supply and demand. And the surge in business CapEx in around AI, it's making that calculation a little harder to judge. But in the period ahead, we're going to be trying to judge just that.
And if I could ask, where exactly was the disagreement today? Was it about the inflation forecast, or was it something more around the risks, the tactics?
Yeah, so I'm going to I'll let the dissenters speak for themselves. The way I heard it over the last 2 days was overwhelming agreement on objectives and authority and commitment. I didn't hear anybody walking away from it. The judgments as to how best to achieve the price stability, that was probably the question that we were trying to answer. What's the best move? What's the best strategy? What's the best way to achieve it? And a second question that was asked is, when do we need to make those harder calls? When do we need to make those decisions? And like I said to one of your colleagues, I was comforted that markets in the intermeeting period weren't reacting to us, they weren't reacting to dots or to speeches. They appeared more than ever to be reacting to real-time events. So they're gauging themselves how restrictive the Treasury curve should be. And that, I think, has been a useful development. We don't endorse any particular market move, but I'd also suggest we observe them with keen interest.
Janelle Marte with Bloomberg. Following up on that, there was more uncertainty in the markets about what the Fed would do at this meeting. To some extent, you might think that's what you want to see. But my question is about, is there a point at which you would not want to surprise the markets if they were pricing in something with higher certainty that was opposite of what you were intending to do? What are the risks that you see associated with that?
Yeah, so it's a good question. Surprise is not the objective function. Surprise is not what we're solving for. We have a clear North Star. What we're solving for is how to make the best decisions. Almost everything else should be in service to that goal. By not spoon-feeding markets, by not previewing our decisions, by not sort of giving nudges and leans, my colleagues and I have found in the intermeeting period what we're getting is the views from a very accomplished economist. That's the internals of financial markets. Instead of just repeating or echoing what we were saying back to us, they're giving us somewhat, not perfect, their own judgment. Surprises are not the objective, but at the same time, I would say we didn't come into this meeting feeling constrained by the full range of alternatives we had in front of us.
So some of your peers have continued to discuss how they think about policy decisions, and if you don't offer your reaction function or your way of thinking about it, how concerned are you that you're ceding control of the narrative?
So not very concerned. That's a short answer to the question. When some people that follow the Fed say, well, we don't want your forecast, we don't want your dot, we just want your reaction function, part of me hears what we really want is your forecast, and what we really want is your dot. In terms of reaction function, let me sort of disabuse people of a question that may or may not be real and be out there. Any central banker, especially a central banker where the labor markets are more or less at equilibrium. Any central banker, when he or she sees underlying inflation moving higher, he or she is more inclined to tighten policy. Again, when you've achieved the other side of your mandate and you see underlying inflation falling, he's more inclined to loosen policy. That's my reaction function, and I don't suspect it will cause people to not continue to pry for more, because the truth is, for a very long time in a lot of countries, coming out of the 2008 crisis, where in crisis mode, we were purposefully providing a lot of information, trying to provide a lot of assurance, trying to tell people exactly what we're going to do, offering forward guidance with clarity as if we're tying our own hands behind our back. Well, in crisis mode, that strikes me as a very prudent policy. But in more benign conditions, it strikes me as worth revisiting. But markets and market participants and reporters have learned to devour all of that information, so I take seriously that the pullback of forward guidance requires some transition. Reform isn't easy, but our general judgment is it's going to help us make better decisions, and in so doing, satisfy our remit.
Paul Weissman.
Thank you.
It's coming. There's a mic coming.
Thank you. When you talk about the 2% inflation target, what measure are you relying on?
Yeah, so I'll give two answers. First, let me give the proper standard answer. The Federal Reserve every January outlines a statement of purposes and strategy. And in that strategy document, which I believe was dated January of this year, it describes a measure of PCE inflation as the objective function there. I have enough of my own, so that's our number, we're sticking with it. Who knows, come after next January, what we might say about strategy. I suspect the task forces might have something to add. But I'll say this, some version of the Lucas critique, some version of Goodhart's law in economics should remind us that when we talk about measures of inflation or something else, and we describe those measures as being consistent with our objectives, we might make them such that they're not very good measures or very good objectives. Broadly, if you said to me standing in front of you, I abide fully by the strategy document, we're going to deliver 2% inflation and not a whisper more. But to achieve that, I'm looking at a broader set of inflation data than PCE. So without sort of fully revealing my cards, I'm trying to understand, like my colleagues, what's the underlying generalized change in prices that are happening in the economy. It is not a perfect science. I might have said 42 days ago, I've got a task force for that. But we have a data project that's trying to look and see whether we can't separate the noise from the signal. And so if you would hear a message from me, yes, I care about what the PCE prints are. I care about what the contributions are from CPI and everything else. But my lens is broader than that, even though the remit is quite narrow.
Michael McKee from Bloomberg Radio and Television. I'm struggling a little bit with some of what you've said today, and maybe you can help clarify this. You've said over and over again that your job is to bring down prices, to get prices stable, to hit your target, and that you will hit your target. The market says you're not there yet because they've raised rates, but all you've talked about today is talking about it. And it's not like members of the committee weren't there before you talking about it. So I guess what the American people might be asking is, what are you waiting for?
Yeah. So believe it or not, this press conference is not all I've done today. We have spent an inordinate amount of time in the last 2 days, 2 weeks, looking at our monetary policy strategy, evaluating our tools, thinking hard about the sources of data that we have at our disposal and we wish we had. We've also thought hard about the period ahead. What among these questions will be answered with more clarity, certainly not certainty? So the decision we'd made today, the discussion we had in that room, was the farthest thing from inertia I can imagine. As a point estimate at this very moment, in a choice between two alternatives, you heard the results of it. But I would tell you that this discussion was far more robust, and our thinking about how best to achieve that target is advanced. And over the coming months, I expect it to be advanced much more significantly. If you were to if I were to steal a follow-up question, you won't be giving it up. If I were to steal a follow-up question, well, what's the world think about what you've done? I would again reiterate, what we do isn't just about what we say. It's not just about what we do. We're in the performance business. And so if I look at the Treasury curve, if I look at the dollar, if I look at a lot of things that are internals inside of financial markets, I think what they're broadly saying is that this committee does own it, has the credibility to deliver it, and they believe, like I do, that we will. But I don't want to leave you with a misimpression. We've got no magic wand. This isn't something that we're going to be able to carry out in days or weeks. But we're going to deliver on the responsibility that Congress gave us. And today's meeting and the preparation for today's meeting was an important step towards that destination.
I'd like to follow up on the task forces as well and ask, what vetting did you do of the people that you appointed to the task forces? In particular, given Mark Andreessen's substantial political spending, $25 million in just the past year to back candidates who oppose stricter AI regulation, how can the public be confident that a committee he co-chairs will provide an independent assessment of AI's economic effects rather than one aligned with the interests of the AI industry?
Yeah, so I selected 15 incredible subject matter experts to tackle 5 of the most important questions that if we get the answers right, we're going to do a far better job in delivering. And if we get the answers wrong, we have a problem. The comfort that I can give you and your listeners is we're the decision makers. The chairman of the board of the Federal Reserve and the members of the board and the FOMC, we will be the consumers of the outputs from 5 different committees. The judgments we're making will be informed by, but not at all determined by, these outside groups. My theory of the case in establishing the task forces were to pick people with extraordinary talent, depth of expertise, and a divergence of views inside every committee, so they too can have a family fight. This is not outsourcing to people that aren't known and haven't been vetted. This is seeing whether new ideas can catalyze a broader, better, more informed discussion inside the room. And I'm very confident that we're going to be able to do that. I am impressed by the credentials of these 15 people. And full disclosure, I've known almost all of them for a very long time. And I think they're going to give their best views on the subject. But ultimately, these are decisions we're going to make, and we're accountable to our oversight committees and to the remit Congress gave us to deliver.
Hi, Ann Safir with Reuters. Nice to see you again. So I need a little help here, too. You've said repeatedly you have no tolerance for inflation, and yet we are seeing above target inflation repeatedly for 5 years and through your term so far. And sure, you have no magic wand, but you have not taken action. You just gave us a little peek at your reaction function as well. You said that if underlying inflation is rising, that you would tend to think that you might need to tighten. And with the exception of the most recent inflation print, that is what we've been seeing. So could you explain what you mean by no tolerance for inflation and what you plan to do about it?
Sure. So, Ann, I hear from you what I hear more broadly from households and businesses: impatience. Deliver it already. This is not an excuse. This is a fact. This FOMC, this board, has been in business for 8.5 weeks. The patience, the impatience that households and businesses feel have been going on for 63 months. We are on the job. We will deliver. We are focused like a laser on making sure we can do it. But the suggestion that we're going to be able to do it with our magic wand is one I want to disabuse you and everyone else of. But the discussion in the last 2 days give me more confidence even than I had 8.5 weeks ago. This team that we have at the FOMC, the support that we have from board staff, and the new hard questions we're asking, we need to resolve those. And as we resolve those questions, get smarter on those, we're going to deliver on the remit. You don't have to take my word for it. If you look broadly at market prices, they are certainly not saying all clear, but they are working in concert to keep us on our toes, and they have tightened financial conditions in this intra-meeting period, and that has given us that has provided us some comfort that we've got the ability and capability to deliver.
And is your read or your, I guess, faith in markets' ability to sort of make a judgment and then you to take signal from that judgment, how does that affect you when you come up on the September meeting and markets are seeing a near 100% chance of a rate hike as they see now? How does that feed into your decision making and your thinking?
So we're not going to be constrained by market prices. We're not going to be constrained or take verbatim from what the market's doing. But I think it's useful and to understand that markets can be a very good source of information. not a determinative source, not a perfect source. But if we're trying to land the plane and deliver 2% inflation, and we take a very useful source of information and we get it all fogged up by giving it our own forecasts, by providing rolling commentary, I can assure you that we're going to have less information, less ability to land the plane successfully and deliver price stability. We're just trying to make sure that that source of information is as direct and unfiltered as possible. It isn't to the exclusion of data sources and opinions and other surveys. But if you're hearing from me, we wanted to make sure we were getting a better source of information. I think in a relatively short time we are.
We'll go to Brian Chung for the last question.
Hi, Chairman Warsh. Brian Chung with NBC News. So you said you'd be open to having press conferences when there's news to make. So today, no change to rates, no forward guidance. For the average household, I guess, what was the news today?
So apparently it was news that I had a press conference. Let me just see if I can offer some clarity on that. Between now and year end, my predecessors and the Federal Reserve committed to press conferences this year. I'm committing to press conferences this year. That might be news to the people in this room and of no particular interest to your viewers and your readers back at home. What I can offer as assurance is that the Fed's on the case, that this Fed chairman feels better about this board and this committee's ability to deliver than I did when I showed up here on the first day, and I showed up pretty confident. I've been heartened by the reception that I received. No doubt in some of your commentaries today, you'll talk about a divided Federal Reserve. Well, that's not the feeling I felt the last couple of days and the couple of days before it. What I felt was a group of professionals, all with different perspectives, different views, different judgments, but eager to roll up their sleeves and have a family fight, and eager to reform the way in which the Fed does policy, a keenness and open-mindedness and curiosity about that, so we have a far better chance to deliver on the remit that Congress gave us. And so I want to leave you with the optimism of a new central banker that we're committed as ever to deliver and to offer an assurance we will. Thank you all very much.
That was the Fed Chair, Kevin Warsh. I'm going to start with a quote from a late Fed Chair. This one, from Alan Greenspan. I know you think you understand what you thought I said, but I'm not sure you realise that what you heard is not what I meant. I don't think anyone really understood much the last 45 minutes, and the market right now is still trying to figure it out. The chairman talked about this market move we've seen in between meetings. This market is playing the ball and not the referee. Take a listen.
Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades. In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit.
So is the Fed Chair outsourcing monetary policy to the market? And if it is this market starting to wonder whether this Fed will actually follow through? The most important part of this move today and this market cross-asset is in the bond market. Check this out. Look at the yield curve. 2-year yields questioning whether this Fed will actually follow through on an interest rate hike. Yields dropping at the front end by 6 basis points. And with that questioning, the conviction to actually do something about the inflation that the chairman is telling you they will do something about. Look at the longer end of the yield curve. 30s untethered. Yields up by 7 basis points. 5.16 on 30s. Lisa, that's an interesting market reaction to a Fed chair that for many was confusing over the past 45 minutes.
Frankly, he came out, said that he was really happy to have the input of the market, but he wasn't outsourcing the Fed's decision to the market. He talked about these 4 goals, these deep questions that we talk about every single day, but gave no conclusion as to direction. He talked about divided committee is not divided, but united in a determination to bring down inflation. And this market said, you know what, we're going to call BS on this, and you're not going to hike rates, and you're going to try to jawbone us, and you think that we're going to do the job for you. And so they're calling the bluff.
I would like us to extend this show to 5 p.m., frankly, John. I know you got early hours tomorrow morning, but that was an historic press conference. There was all sorts of little tidbits there, and we've got wonderful guests to talk to about this. But every sentence of that was radically different than anything we've seen in recent years.
Allow me to quote another central banker, and this is the Fed governor on the board right now, Chris Waller. Going into the quiet period, he made this statement: sternly staring at inflation until it melts before our withering gaze is not an option. Bramo, is it an option?
So what I love from Renaissance Macro, from Neil Duddy, came over and he said, Warsh, my own judgment is this is a period of watchful thinking. So I guess a withering gaze is an option, because ultimately Kevin Warsh could not answer the question. If you still believe that inflation is a problem, why did you not hike today? He could not answer that question. What would make you hike? Reaction function. Reaction function is just guidance, is just a prediction hidden in that. Is that true? No, it's an understanding of which data and what could potentially make you pull the trigger. What I also think was interesting, he kept saying that the market is a pure input into what the market believes that the data is showing us. No, and Neil Duddy points this out too. It was a reaction to Fed speeches that were indicating they were moving in a more hawkish direction. This is very difficult to say that this market is just playing the ball and not the referee.
3 dissents at this Federal Reserve meeting, rates kept unchanged. The confusing news conference for the past 45 minutes. Bramo, did you nail it?
I missed Close. By 20 seconds, I believe.
Nice.
No, by 17 seconds.
We were taking bets on how long this news conference would last. Bramo came pretty close.
45-32. It was a 45-18.
Is play the ball from Caddyshack?
I'm not sure where that quote is from.
Play the ball, not the referee.
Isn't that fairly well known, that quote?
I think so.
Right?
From the World Cup.
Yeah, I think so.
Oh, it's from the World Cup.
OK, all right. 2-year yields down by 7 basis points. Stop derailing the programme. Torsten Slock of Apollo with us around the table. Torsten, good afternoon.
Perfect guest.
Hey, big challenge for you, buddy. First up, translate the last 45 minutes. What did you learn?
Well, the first observation is that Powell actually also had 3 dissents in April, and he also had 3 dissents in December. So having dissents is not unusual. That's not a Warsh thing. We also had that under Powell. But that being said, there's very little to hang your hat on in the market. We didn't get any guidance in any direction, and it was also a little bit complicated to figure out what was the basis for the decision today, in the sense of when Mike McKee asked, well, what are we waiting for? We didn't get a clear answer for what exactly are we waiting for, which was, of course, was a subtle way to try to get some forward guidance. But this is the part of the challenge. We're not delivering forward guidance, that when Mike and others ask about what is it that you're watching, what exactly should we be watching, then the answer is that we're not really giving any guidance, and the market can figure it out on their own. The
price for that is volatility, and you could see that in the swing in the market over the last hour or so. Equities were positive, they turned negative again. Bring up the bond board if we can, and just look at 2s, 10s and 30s. This move in the yield curve, Torsten, I'd love to get your reaction to this, because you were watching this closely throughout the news conference. This move at the front end and how it informs this move at the long end of the curve.
Well, what was interesting was that 10-year rates really went up and down like a yo-yo for a better part of the conference. That's a little bit unusual. Normally, 10-year rates take a step either up or down as we move forward in the press conference. But the fact that there was such a swing, it is also telling you that markets are trying to figure out, are they hiking at the next meeting? So yes, Fed Fund futures are saying now there's a 70% chance that they will hike at the next meeting. But what was also the interesting question is, when he was asked about, well, if markets then are predicting, say, a 80%, 90% chance of a hike going into a meeting, are you going to deliver on that? And the answer was, no, we're not going to deliver on that. It will all be contingent on the debate that we're having, and markets may be pricing what they're pricing, but we're still going to go with just what the committee is thinking. So in that sense, the market pricing in some sense is helpful, but at the same time, we in markets can't really even rely on that if expectations are saying we're getting a hike at the next meeting, that we are actually getting a hike.
What this market is saying right now is that he's bluffing, because if you take a look at it, it was 70% chance of a September rate hike. Now it's 50% chance of a September rate hike, and dropping in real time. How much do you view the 30-year as the real tell in terms of what the market is taking from this Fed, which is potentially you're not going to hike rates and you're going to hope that job owning is just going to do the job?
Yeah, because 30-year rates are basically saying if you're not hiking rates, then we are hiking rates. And that's why 30-year rates have just made it much more expensive to borrow, to buy a house. And as a result of that, financial conditions are tightening. Right. And he didn't tighten financial conditions, but the market decided to say, well, then we think it's time to tighten financial conditions.
And John, I know you've got a question. The key thing to me, John, is 30-year rates, 520 is a key print. we're at 517. 520 is an OMG print.
The price of volatility, is that what we're learning? The price of reducing guidance, reducing communication, being very, very unclear about what on earth they're going to do with policy. Are we paying the price this morning and this afternoon?
But that's why the task forces will be very, very interesting, because they will certainly also, on the communication task force, they will have to discuss what is the best approach. Is it the best approach to have no forward guidance? Is it a better approach to have forward guidance? If you do not have forward guidance, you do have more volatility. But in fairness, to Kevin Warsh's point, he did say that, well, when we don't say anything, markets are reacting to the data as we go along. But the risk, of course, is that if the market is overreacting to some data, that then also needs to be resolved in the task force on communication, namely, is that the right way to do it? Because it runs the risk, as you're saying, John, that you will have more volatility.
Torsten, thrilled to have you here with this really odd press conference. There was a bombshell in there where he went back to 2014 in a paper he did on the Lucas critique. It's just slipped in there for a second. But to academic economists, that is a bombshell, what he said. And what he's basically saying is the distrust that Robert Lucas, the laureate, had of models. Are we, I think of Claudia Sam, Lisa, you mentioned this earlier, the idea of reaction functions. Is this a new, almost model-free Federal Reserve away to Lucas and even away from the giant Olivia Blanchard?
It does lean into the Chicago Stanford School of Thinking, namely that when you have a policy that you're changing, you should not run regressions and look historically at the data up to where we are now, because the change in the policy is going to change how people behave.
Is there a new model then? Is there a new fresh Warsh model we need to discover?
Yeah, because I think he's saying that you can't just look at all the models that look back, because when we are now changing policy, then forward-looking, people are going to change behavior.
And how do you determine an inflation rate across that? If you take DSGE, Richard Clare, Gertler, or Brown, if you take the mathematics of that, throw it out the window for this show. But the bottom line is inflation is the measurement we use. How will we measure inflation with a new Warsh-Lucas model?
But that's exactly right, Tom. That's why if you don't have the models that look at the latest data, then what are you then looking at? What are you then relying on for forecasting what inflation will do going forward? So in other words, if I'm not allowed to look backwards and say this is where the data is coming from and the trend is whatever this or that, well, then what am I then using as the guidepost for thinking about what inflation will do going forward?
Was that
10 basis point move on 30s. There it is. Wow. Almost higher by 11 basis points and closing in on 519. I'm thinking of all the people that would be unhappy with this news conference in the last 60 minutes. Forget market participants. Imagine being at the Treasury right now and you're Scott Bessent and you're seeing yields go higher on 10s, materially higher on 30s. And then I'm thinking about the others on the committee. I'm not an establishment guy. I'm very, very happy to blow things up and have a new era. I've got no problem with that. I'm open to new ideas. But I just wonder how offended some of the sitting officials might be by how patronising much of that news conference was over the last 60 minutes.
Well, it's clear that the sitting committee that he came into had already thought about basically all areas of the task forces before. So it's clear that the market here is saying, well, if we now are getting a day with a no hike, well, then the long end, of course, is moving, basically telling you that, well, this is all about credibility. Are you really going to follow through on inflation? And that's, of course, the thing that the FOMC needs to go home and think about now. The market reaction speaks very clearly that now we need to talk about what is the credibility of the committee, because it cannot only be talk. You will eventually have to follow through. And that's why the probability, given this market reaction now, has gone up quite significantly that they will have to move at the next meeting.
But this is really important. In other words, you're saying that the reaction, the long end of the yield curve, is a challenge to the credibility of this Federal Reserve and will force their hand. That if they do not hike rates in September, you will see some sort of unmooring of long-term yields.
Yeah, because the risk is if you keep on just talking tough, and therefore markets end up saying, well, this is just a lot of talk, and you don't deliver on that tough talk, the risk is, of course, that the long end will say, well, if you don't deliver, we worry that you are implicitly allowing inflation to be higher, despite the talk about not allowing inflation to be higher. And that is indeed a question about the ultimate credibility. Is the committee ready to vote next time? This was not only Kevin Warsh, this was 9 members who voted to keep interest rates constant at this meeting. So at the next meeting, many of them must look at the reaction today and come to the conclusion, if we want to keep our credibility, we do have to move to make sure that inflation comes down, and therefore ultimately long rates also begin to go down.
Michael McKee was in the room. Our colleague joins us now for more from Washington, D.C. Michael McKee, we'd love your review of the last 60 minutes. What's the big takeaway?
Well, I think it's very similar to yours. A lot of words, not much information, and the Fed chair leaves with markets probably going the wrong way from what he would like to see at this point. The thing he wouldn't answer is what they actually did today. He talked a lot about talking, but when are they actually going to do something? Whether it is acknowledging that the 3.5 to 3.75 rate range is adequate for the job they want, or it's not, and they need to raise interest rates. And there was no acknowledgement of what the case was really on either side. It was a lot of talk about, well, we're talking. And that doesn't get the markets anywhere, and people aren't going to be very happy with what they heard, I think.
Mike, there was an interesting exchange, and you were part of it too, when he was asked, why didn't you raise interest rates? And he basically said, well, I think rates did rise. And he talked about the move in the last 42 days. And Mike, rates rose because for many people, they thought this Fed might follow through on the data that we've been seeing over the subsequent few weeks, follow through on some of the Fed speak that we'd seen from the likes of Waller, the likes of Hammack and others too. And Mike, and then it got to this moment where it just thought, OK, is the Fed chair outsourcing monetary policy to the market? And if he is, well, then I don't think he's going to hike interest rates, so we'll take all that back. And Mike, then we see this move in the bond market. And I don't want to make too much of a big deal of this move. We can take it back tomorrow and in the next week or so. But it's material. You're up 11 basis points at the long end of the curve on 30s. And Mike, the conversation we're having around the table, do you believe that is a market beginning to question the credibility of this institution?
I don't know if that's necessarily true because it's still so early in his chairmanship, but it is an indication that the market disagrees with what the Fed is doing. The market thinks at this point that interest rates should be higher. And whether or not you believe it's because they're only looking at the data, it is telling the market something, that data. I suspect that the markets are still looking at the data and putting it in context of, well, what's the Fed going to do about it? Because the Fed controls the benchmark lending rate for the country. The markets don't. The markets react. The markets move around. But the benchmark rate is going to be set by the Fed, and the Fed is going to be reacting to the conditions in the economy. And we got nothing on what he thought the conditions in the economy are or would be, and we got nothing basically on why the markets might be right or wrong and whether that's an adequate response, an adequate measure to keep inflation under control.
Mike, thank you, buddy. These comments from the president certainly won't help. So we've got the White House review of things they've just published. This is from the president. Kevin Warsh is fantastic. Warsh has a board. It's a political one. Warsh would love to see lower interest rates. Given the move we're seeing on the screen right now, 30-year yields up by 11 basis points, those comments from the president this afternoon will not help.
30-year yields have just broken through the highest levels going back to 2007. Just to give you a sense right now of the bond vigilantism that you're seeing in bond markets, because they are seeing a more potentially politically motivated Fed, not necessarily that being the case, but given the lack of clarity, a lot of circular talk, the lack of any kind of straight answers about reaction function or exactly why they remained on hold, and then the president's comments are not a good brew for this particular market.
Not at all. And Bramo, to your point, I think we're both on the same page about this. I don't believe that Kevin Warsh is doing the president's bidding right now. He's widely backed by several establishment figures when he got the nomination for this job. I'm thinking of one. I can't think of anyone more establishment than Mark Carney, the Canadian Prime Minister, who gave him a pretty fantastic endorsement when he got selected for the position. I don't think he's doing the president's bidding, but the optics of it absolutely stink. When you have a problem with inflation and you're saying you're committed to doing something about it but don't follow through, and then highlight the market that's doing the work for you, and now the market's beginning to push back, and at the same time the president's putting out words saying, well, this is actually what Kevin Warsh wants, the optics of that, the backdrop for it, not a good one.
And conflating the idea of a Fed funds rate with the market rate and saying that there was something that happened and that we have done something because that moved. The market's saying, we're not that silly, we're not that ignorant. We know how this is done. It was an anticipatory market, and if you're not going to make good on that, we're going to call your bluff.
Hey, John, this is an historic moment. The charts I'm seeing on the screen right now, John, I've never seen. This is basically what's called a reverse operation twist in real time. We've never seen it. And what's key here, which Torsten, and I know you've got Stephanie Roth on deck, the first and second derivatives of this move have to be digested by a huge body of the American economy. Let's just start with the housing market. as just one example.
Well, let's just start with what we thought this was all about. There was a belief that we were reducing forward guidance so that we could introduce some volatility into the front end of the curve, which would help cap longer end yields, that you'd start to be more uncertain about what this Fed might do, but in a different way, that maybe the outcome would be more hawkish than it would have been otherwise. And what we saw more recently, Lisa, was that dynamic. People were talking about it. This would contribute to longer yields over time at the longer end of the curve, lower yields over time. That's not what you see this afternoon when you drop by 5 basis points at the front end and you are seeing a move of 11 at the long end through 520 on 30s. That's not good. That is not the outcome people were looking for.
No, volatility, if you truly are potentially on the fence and are going to move, is one thing. But if you've got a parent who's saying, if you do that again, I'm going to turn the car right around and go home, and the kid keeps doing that, and the parent keeps driving straight to go to the amusement park, well, guess what? The kid's going to keep goofing around in the back seat, and that's what's going to keep happening. Because ultimately, if you don't believe that they're actually going to do anything, why should you start to prepare and price that in?
That right there, that's experience, TK. That's experience. That's like real world experience.
Do you do this thing when you're driving and you lean over at the same time?
No,
Lisa has pulled more than one U-turn in her life.
100%.
Stephanie Roth of Wolf Research joins us now for more. Stephanie, welcome. It's a confusing one. Sometimes this is straightforward. The last hour is anything but. What's your takeaway?
Yeah, I mean, I think markets just don't believe them. The thing is, I do think that the Fed will that the data will ultimately bail out the Fed to some extent, because the market's saying we don't believe that the Fed is necessarily going to be hiking in September. That raises inflation expectations. That does exactly the opposite of exactly what Warsh had set out to do today. If we do end up seeing inflation data come in a little bit softer, that might bail him out. He's basically, rather than doing watchful thinking, he's really doing wishful thinking. If the data ends up coming in line with his side, this may all work out. But if not, this could end pretty poorly.
You said his side, and this is important, Stephanie. It seems like the takeaway is that Kevin Warsh is much more dovish than people previously thought. Do you think that that's the correct interpretation?
Yeah, I think he didn't want to say anything because he didn't want to make it clear that he is, in favor of staying on hold. He wants to make to have markets do the work for him. The problem is, like you all were talking about earlier, that might have worked up until now. Following what we've heard today, the markets are going to do the exact opposite. And then what is he going to say in September? So I think this is the market realizing that the first FOMC was him trying to establish credibility, trying to come across as hawkish, and now markets are just not buying it.
Torsten Slok, I've got the 30-year at a 5.20, rounded up to 5.21. We can do that this late in the day. If I have this move into 30-year yield, I'm out 2 standard deviations. How will finance, obviously you're good people at Apollo, but how will finance adapt to what they heard, adapt to this reverse twist? I've never seen it. How do you adapt tomorrow morning?
Well, this is a very historic day in the sense that we have seen a very significant steepening of the curve that is quite dramatic. I'm trying to think back when we ever seen like 20 basis points move in the curve in the steepness like this. It is really unusual. And the answer to your question is that the sensitive components of GDP that are interest sensitive, of course, housing and autos, will probably continue to struggle. They have struggled for quite some time when interest rates have been high. But the tailwinds to growth coming from AI spending, coming from the one big beautiful bill, coming from the home shoring, those things will still continue to see tailwind. That's why we might get in the next half hour, when the news come from both the hyperscalers today and tomorrow, this could also create some more volatility, because that will also begin to become a macro event if that does begin to send signals around what is the outlook for the broader economy, especially around the data center build-out.
Torsten, can we talk about the price of the data center build-out and the capital raising that we're seeing worldwide right now? 30-year yields up 11 basis points. That's before we even find out the CapEx intentions of some major companies in the next 24 hours or so. How much pricier does the cost of capital get with this Federal Reserve?
Well, that's exactly the discussion, because not only, of course, have spreads on hyperscalers widened out and CDS has also widened out, now the base rate has also moved up, and in this case, actually much more than spreads have widened out. So the all-in yield for financings, of course, in the public market for hyperscalers have definitely increased quite significantly. The issue now becomes, well, if your returns in AI are expected to be like 10, 15% or higher, well, then these things are relatively small peanuts relative to the big picture of the returns that are going to come along. But ultimately, that discussion is all about the economics 101, namely what is the marginal revenue you expect to generate and what is the marginal cost of producing that piece of revenue. So for compute, the debate is around well, now that rates have gone up and all-in yields have gone up, is it the case that we're reaching a level of all-in yields or all-in cost of capital that's beginning to become more problematic for the hyperscalers? So far, that has not been the case, but the question is, of course, over the next 24 hours, whether we get any either confirmation that that's happening or whether we are, on the contrary, beginning to see still more upside risk to more data center build-out just continuing.
And this is a reason why, and Stephanie, I'd love your thought on what Torsten said earlier, that all of this is not a virtuous cycle and it's not something the Fed wants to see. And so Torsten was saying that he thinks that the probability of a September rate hike is even greater now to try to control the long end of the yield curve and prevent this sort of higher borrowing costs for some of these hyperscalers and the build out. Do you agree with that?
I mean, I do if the data don't improve. So if we're sitting here in September and the data just continue to remain firm, especially on the inflation side, but also on the growth and the CapEx data in terms of CapEx, just AI-related CapEx just continuing to move higher, then yeah, absolutely, that increases the odds that they're going to ultimately be hiking. I do think that we'll see seasonality in the inflation data and a bit of a cooling such that that this may all work out such that the Fed doesn't actually have to cut in September. And in that environment, it will do so in an environment that's a little bit more market friendly. But if that forecast is wrong, then absolutely, they're gonna. This makes them even more likely to have to be cutting in September because it tells you that they're making a policy mistake.
I look at this moment, John. Of course, I got to go to the quality full faith and credit document. SpaceX's 30-year bond. 6.65%. We're enjoying it at 7.8% right now, not quite through a new low. But again, the mystery to me is the permeation of this through Wall Street. It's not just about FOM's, Lucas critique and all that. What does this do to Wall Street starting in Asia here in X number of hours?
You mentioned SpaceX, so they came out with that debt issue in the last month or so, and the demand was softer, below average. And then we had Amazon follow up TK, and concessions were larger. Yeah. And then you start to see spreads widen out in the secondary market too across a number of tech names as well, Tom. And we've been talking about this dynamic for a while, the crowding out of the market, that there is a race to raise capital, and that we've been worrying about the additional supply coming from the Treasury for the best part of 15, 20 years, the deficit. It was okay at the time because not everybody else was doing the same thing. Now, we talked about this already earlier in the programme. Germany has gone away from fiscal prudence to borrowing and spending. Germany has moved on to something else. Japan has as well. They've had decades of deflation. They now have inflation. Anchors away there for that bond market, yields up. We've now got the hyperscalers moving away from buying their own equity to negative free cash flow and now issuing equity and issuing debt. That's additional supply here, there and everywhere. And everywhere you look right now, there are increased capital demands. So to have the Fed chair perform in the way he has in the last 60 minutes, to see the market reaction to that that's led to high yields at the long end of the curve, to have that in this moment, Lisa, things get tighter, things get harder, and yields go up and the price for capital gets more expensive.
And the value of the dollar on the global stage goes down, and we're seeing that in a pretty big way. It is notable to see the long end of the yield curve in particular perform this way. And as Torsten made a good point about the hyperscalers, they have been issuing disproportionately at the long end of the yield curve. They have issued more on the long end than the U.S. government. And you have to wonder how much this is going to constrain some of the productivity and the virtuous aspects of what a lot of people are expecting and prolong that uncomfortable mismatch period that he was talking about.
There's also the additional challenge that if you take your textbook out and interest rates go up in the long end, the dollar should be going up. So that's why you're now beginning to ask, well, is the dollar now beginning to react to front-end rates? Normally it is long end that moves the dollar most. So there's a lot of considerations also around why is the dollar going down so much at the same time while short rates are moving down and long rates are moving up.
Stephanie, in the next 2 weeks, we'll all be very focused on the Fed speak. We were calling this a three-part act all day. The statement's one act, the news conference is another. It was quite an act. The third act is going to be the speeches of all the officials that haven't had their say yet. What are you looking for from the Fed speak in the coming weeks?
Yeah, so we're certainly going to hear from those that dissented. Why did they dissent? Because Warsh certainly didn't really answer that question. So we'll certainly hear that argument. And then I'm going to be looking for eventually the next speech by Waller, because that's going to give us a sense of what did the core of the committee actually, what is he thinking? He's been amongst the most transparent and represents more of the middle folks on the committee, and that's going to give us a much better sense of what are they thinking, what are they leaning, and what does he think about what price action is doing? Because he is somebody who's very willing to give his reaction function and his thoughts on what markets and the data are going to do.
That's right where I wanted to go, Stephanie. Torsten Slok, how does Chairman Warsh react to what we're seeing on the screen, the data, and the fact is he's going to have to amend the way he speaks, the concepts he speaks, the McKinsey MBA of it, and talk to academic economists?
I think that it's not only him, it is the 9 versus 3 on the committee here, that there were 9 members who voted to keep rates constant today. So the consideration for the whole committee must be to go home and think hard about how do we communicate this? Do we do this before the meeting? What do we say at the press conference? How do we communicate it in the statement? Because it is clear that this is a somewhat worrying development, especially in the long end. We do have next week non-farm payrolls. Let's not forget that. So to Stephanie's good point, the data could begin to move in the opposite direction. Yeah. So who knows? We all have all kinds of views on what might be happening on the labor market at the moment. So far, it's been relatively strong. But you're right, Tom. At this point, it must really inspire them to look themselves in the mirror here and begin to think about how do we think about this situation and given what just happened today.
Lots of Fed chairs make communication errors, particularly at the start of their term. We've seen that repeatedly in Federal Reserve history. This in that way might be no different. We do have to go through this process and start to understand how this new Fed chair communicates, what it means to markets. And I mentioned this earlier, this move in the bond market, don't know where it goes, we could take it back tomorrow. That's not really the point. The point is, whether this is by design or not, is this the intention? Is this actually what Kevin Warsh, the new Fed chair, wants to see? Is this the outcome to that news conference that he was looking for?
Well, if the data is speaking, the market is speaking, and the market is saying right now we don't believe you. So does he have to come out and hike rates? Who is his audience? Who is he speaking to? I ask that because typically Fed chairs have an odd job of trying to toggle between the broader public and the markets. He wasn't speaking to the markets, or if he was, then he's not getting the reaction that necessarily he wants, given the fact that they've talked about wanting to bring down mortgage rates in particular, and this is going to move it in the opposite direction.
Stephanie, it's good to see you. It's always great to catch up. Stephanie Roth there of Wolf, Torsten Slok of Apollo, weighing in on this decision from the Fed chair Kevin Warsh, and a decision by the committee to keep interest rates unchanged with 3 dissents from 3 regional Fed presidents, and then a very confusing news conference that has come with a price. And that price this afternoon is high yield to the long end of the curve.
Yeah, the highest levels that we've seen since 2007 at one point in the final moments of the trading session. You have to wonder, to your point, whether he is satisfied, as well as whether he is going to rethink how much information he would like to disclose. It seems like he thinks the less information he gives is a virtue. However, I think a lot of people would say that maybe this is not the controlled kind of response that leads to any kind of predictability.
John, quickly, the bank rate 30-year mortgage is 6.70%. Are we going to enjoy an 8% mortgage soon?
After this is going up. I don't know about 8, but it's going up after this if this continues, without a doubt. The Fed chair Kevin Warsh wrapping up his news conference. The good news, maybe it's bad news for you, I don't know. But we'll be here at every meeting because there will be a news conference for the rest of this year. After every meeting, a commitment to that from the Fed chair.
Again, why then would he introduce the idea of not potentially having one? There's so many questions here. The lack of clarity is one thing if it's instrumental in creating volatility, or if it's lack of clarity for lack of clarity's sake, because ultimately you don't want to invoke political ire. I don't know.
And let's see if these moves stick. Let's start there.
Yeah,
down 5 basis points at the front end, up 11 at the long end. Coming up tomorrow on Bloomberg TV, on Bloomberg Surveillance, we'll catch up with Francis Donald of RBC, Max Kettner of HSBC, and a whole lot more.